One of Warren Buffett's most popular investment advice for amateur investors is to buy low-cost index funds and forget about it. In the United States, it is a reasonable thing to say. The S&P 500 has compounded steadily for decades and the market is very efficient. The cost of trying to beat it usually overcomes the rewards. Even Berkshire Hathaway, which is run by professionals, has trailed the index over the past 10 to 15 years. The gap has widened noticeably since the rise of the mega tech cap rally. Therefore, it is a strong case for index investing and against active management, isn't it? Well, drop the same advice to Indonesia and it quietly fails. Over the past 5 years, Indonesia's real GDP has grown for about 18%. Over the same window, LQ45, one of the most watched index in the country, has gone essentially nowhere. Simply put, a retail investor who buys the index in Jakarta has not captured the country's economic growth. They have captured the dysfunctions of a market whose structure has not meaningfully changed for a number of decades. This is the part where most cross-border advisors misses. Buying the index does not eliminate the risk of investing entirely. It only eliminates the risk of underperforming against the index. When the index itself has gone nowhere, a portfolio that tracks the index would follow suit. Indonesia, like most emerging markets out there, runs on an efficient market. Price manipulation by unwanted actors is rampant. Regulatory enforcement still requires refinements. Liquidity is thin compared to developed peers. And as a further illuminating example, Indonesia's Finance Minister Purbaya recently declined giving fiscal incentives to the Indonesian stock exchange because the culture of goreng-menggoreng, artificially engineering stock price, is still everywhere. So it seems to me that the whole thing we see in Indonesia today has more in common with the American capital market in the 1970s than the S&P's 500 that we see today. Howard Marks, co-chairman of Oaktree Capital, managing well over $100 billion in asset under management, built his career exactly here. He delved into the US high-yield bond market when it was illiquid, ignored, and full of mispricings. It was so inefficient that people called it the junk bonds. His core lessons age very well. Successful long-term investing comes down to buying an asset for less than it's worth. The more inefficient the market is, the more often prices stray from underlying value, and the more room there is for active and disciplined work to outperform over time. There is a generation of working professionals across Southeast Asia who, for the first time, know that they should be investing. They have brokerage apps, they have podcasts, they have thousands of influencers, and an unlimited supply of AI chatbots willing to explain to them about compounding. What they do not have is a practical framework that rewards that very knowledge. AI in particular is tempting but flawed. The economics of consumer AI products favors engagement, not returns. The model is built to keep you typing and putting prompts further. For example, if you feed it a hypothesis that you already believe, it will help you justify it. True, you can ask AI to spit out a bunch of bear cases for you to be wary about, or a list of unknowns, but you still largely need to build the convictions yourself. That is not a malicious feature of AI. It is how their business model is designed. The more tokens you send to their servers, the more money they will make. So you end up with a group of unique investors, those who understand the philosophy of long-term ownerships through investments, who have easy access to investment instruments their parents never ever did, and who's well aware from first-hand experience that investing in the index is not a good enough solution to their financial goals. As a result, they get funneled into expensive, over-regulated mutual funds or do-it-yourself trading applications that wear them down emotionally during market downturns. Not ideal. Morgan Housel makes the point in the book, The Psychology of Money. Our behavior with money is shaped less by abstract concepts than by the monetary events that we, our societies, experience firsthand. Germany is a striking example. The collective memory of Weimar hyperinflation helped create a persistent preference for gold. Today, private Germans own more gold bullions than the Bundesbank itself. Indonesians and their neighbors also have a unique formative experiences. The 1997-1998 Asian financial crisis, meltdowns, a class of individuals burned by blue chip stocks, and so on. That is the structural feature of a Southeast Asian investing culture. We live in low trust environments, and we will continue to do so for the foreseeable future. That fact reshapes the whole map. In the United States, the retail investing culture evolved around self-service, Vanguard ETFs, Schwab robo-advisors, the implicit assumption that the institution itself would behave, the disclosures would be honest, and the customers could safely automate their investments through their apps. Trust was broadly the essence. Again, in Indonesia and most of its neighbors, that trust assumption does not hold. Customers have learned, often through the hard way, that handing assets to an opaque counterparty is a real risk. So the service that require least possible trust, full custody by the customer, transparent positions, lean cost structures, no opacity around the fees are the ones that we believe would scale. That is the inverse of how Western retail investing developed. And it is why the local solution will not look like a copy-paste of Robinhood or Vanguard. If the developed market answer is automate everything and trust the index, the Southeast Asian answer is likely pointing the other way. It might look like a small human-mediated layer over a market that genuinely needs active interpretation over time. Transparent enough that the customers would never have to take anyone's word for it. Disciplined enough to keep clients invested through market drawdowns the index themselves will never be able to protect themselves from. So Buffett was most probably right for his market. The interesting question for Southeast Asia is not whether to copy him, it is what to build instead. After understanding the monetary and investment context in the society that we live in, we'll find out soon enough. Cheers.